Hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we're going to talk about RRSPs and registered retirement income funds and withholding taxes at death. There's a very surprising quirk in the income tax code that if you're not aware of it, or if your executor is not aware of it, can cause your family some major headaches from a tax standpoint. So this is a very helpful video on taxes as it relates to death when you have an RRSP account or RRIF account. Now, if you're new to this channel, make sure you hit the subscribe button. We're posting content all the time, quite literally on all things retirement, the lead up to retirement, the transition to, and being retired. So you don't miss any of the content, hit the subscribe button. Now, many of you know, of course, that there is withholding tax on your registered accounts. So your RRSP accounts and your RRIF accounts as an example. And if you go in, you make a redemption from those accounts, typically there's a schedule that requires a minimum withholding tax depending on the amount. So under $5,000, there's a 10% requirement for withholding tax to go directly to CRA before your financial institution releases the money to you. Between $5,000 and $15,000, there's 20% withholding tax required. And above $15,000, there's 30% withholding tax. Now, when it comes to redemptions and tax consequences on death, generally speaking, if you have a spouse, a partner, then when you die, your RRSP accounts and RRIF accounts can roll over tax deferred to the surviving spouse. So there's no tax due at that point. Upon the death of your surviving spouse, if they haven't gotten remarried and there's no partner, then at that point, those assets are deemed to be taxable upon death. Now this is where we can get into some complications. Now one of the benefits of an RRSP account or RRIF account is you can list a beneficiary on those plans. Now, one of the major benefits of listing a beneficiary is the fact that when you die, the RRSP capital or the RRIF capital can go directly to those beneficiaries and not have to be going through your estate and subject to probate. So it's quick, it's convenient, administratively it's not very difficult at all, and it doesn't, like I said, take very much time. So a huge benefit to the family, and so many people will list beneficiaries directly on their RRSP or RRIF contracts to take advantage of that. Here's the problem. One of the quirks of the income tax code is that there's no requirement that when the financial institution releases that capital, that they remit tax to CRA before releasing the money to the beneficiaries. So let me paint a picture for you. You've got a couple of beneficiaries, let's say they're in their 30s, maybe siblings, and there's a $400,000 or let's say $300,000 RRIF or RRSP account that gets paid directly to them upon death. Now there's been no tax requirement that at that point to be remitted to CRA. So the two beneficiaries get $150,000 each and they go on with their life. Now a few months later, the executor is filing the year of death tax returns and realizes that there is tax to be paid on those RRIF or that RRSP account, but the money's been already paid out to the beneficiaries. Now we have a potential problem. So again, there was no requirement for the financial institution to hold back taxes. Those beneficiaries now have had that capital for months. And maybe some of that money went to a holiday, maybe renovations in a house. I mean, it's already been spent potentially. So we've got a bit of an issue. The executor goes back to the beneficiaries and says, listen, we're doing the year of death tax returns. We've got a tax bill due. Can we get some of that money back to pay the taxes? Well, you know the potential problems that you can encounter in that kind of conversation, right? It may not go quite the way the executor had hoped. Now, in an ideal scenario, maybe there's other assets still in the estate that could be used to pay those taxes, but if there is no assets or very few assets or insufficient assets to pay the tax bill, then we potentially have a problem. So how do you work around that? Well, the first thing is you need to make sure when you plan your estate that you think through the potential issues depending on which direction you go in terms of estate distribution. The second thing is that you can be proactive. In other words, before the executor goes through the paperwork to get those monies to the beneficiaries with those designations, you can make arrangements with your financial institution to remit tax. So the executive will do an approximation and that money will go to CRA for tax purposes, and then the net amount will go to the beneficiaries. Months later, when the executor is filing the year of death tax return, hopefully they've held back sufficient taxes to look after that tax bill. At that point, maybe there's a refund that's going to eventually come back to the beneficiaries. Maybe there's a little bit of money that has to be paid in addition to what was remitted, but you're not in that very sticky situation where there's a large tax bill and now people are looking for money to deal with it. Okay, so that's just one little landmine that can come up when it comes to estate settlement and planning. Hope you enjoyed the video. And again, if you want to be alerted to future content, make sure you hit the subscribe button. And in the links for this video, you'll find a link to our website. If you have questions, any topics you'd like us to pursue for future videos, make sure you go to our website, send us an email through the website suggesting topics. We also have links to our retirement coaching service and other helpful resources, so be sure to check that out. Anyway, wishing you all the best in your retirement and wealth planning. You take care. Bye-bye.